Okay, so this video lecture is for our module 3. So this is entitled Cost Accounting Cycle. So for the overview of this module, so this will be about the cost accounting cycle that focus on uh, the cost of goods sold statement. Okay, so you will be able to learn about the composition and as well as the preparation of our cost of goods sold statement. So for the learning outcomes, you will understand and familiarize the different sections in our cost of goods sold statement, as well as preparing the cost of goods sold statement, and be familiarized also with the financial statements showing the cost of goods sold section. So for our content, so our three main topic is about the parts of the statement of cost of goods sold, its preparation, and the financial statements as well. But in this case, we will be focusing on still the cost of goods sold statement section. Okay, so to start with, let us discuss about the parts, okay, of our cost of goods sold statement. So basically, our cost of goods sold, this is the accumulated total of all the costs in producing or creating a product or rendering of services that was sold. So if you could still remember in our previous module, okay, so applying the matching principle, so in this case, before we can recognize the cost of the item or the inventory, first we have to wait for it to be sold. Okay, so when this item or inventory are now sold, this is now the time that we can already recognize its corresponding costs. Okay, so that is reflected in our cost of goods sold statement. Basically, our cost of goods sold is we have this general subcategories. Okay, so basically we have the indirect labor, materials, and overhead. So if you could notice, this subcategories pertains to our manufacturing costs. Okay, so take note also that in our subcategories, we will include here the indirect labor and the indirect materials under the factory overhead category, and all the other indirect costs should be included. Only the indirect labor and the indirect materials will be included. Okay, so cost of goods sold, this refers to the direct costs of producing the goods, okay, that was already sold, okay, by the company. So this will again include our materials, labor, okay, and this will include other indirect expenses as mentioned earlier, such as the distribution cost and sales force costs. But we will still include the indirect labor and indirect materials as part of our overhead costs. So for a service type of business, their cost of services, actually, that should be the term that we will use. Okay, this is considered to be to include, I mean, the labor, okay, and the labor pay, of course, of the worker, which includes the payroll, taxes, and as well as the benefits, okay, of those people who generate the income by providing or rendering of the services to their customers. Okay, so again, for a service type of business, the equivalent term for our cost of goods sold is cost of services. For a retail or wholesale business, so basically this is what we call a merchandising type of business. Here, their process is to buy from the manufacturer the item or the inventory and then resell it, okay, to their customers. So here, for a merchandising type of business, they can use the term cost of sales, okay, as the equivalent term for our cost of goods sold. Basically, cost of goods sold, this is for a manufacturing type of business. So this is what they will use as a subheading, okay, in preparing their income statement. So in the presentation of our cost of goods sold, basically, as mentioned also earlier, this is in our income statement. So this is deducted from our net sales or net revenues to arrive at our gross margin. So since this is cost, basically this is a deduction. Okay. So here we have if the entity is using either a periodic or perpetual inventory system, so we will have somewhat a different accounting procedures, okay, for our cost of goods sold. If an entity is using a periodic inventory system, meaning every time there is a sale or purchase of the inventory, they do not reflect or record the decrease or the increase in our inventory. So they just wait for a certain period of time, for example, after the accounting period, to account for the ending inventory. So this is what we call periodic inventory system. There is no updating of the inventory level when there is transaction that relates to it, such as the sale and purchases. So again, they just count their inventory at the end of the accounting period, and then they will use this formula in calculating for the cost of goods sold. So if the entity is using periodic inventory system, so this is how they would compute their cost of goods sold. First is to add the beginning inventory with the purchases. So the total of this is called the total available goods for sale. Okay, and then after which we will deduct the ending inventory to arrive at our cost of goods sold. So this is how it is done under the periodic inventory system. The assumption is that the result, which represents cost no longer located in the warehouse, must be related to the cost that was sold. That's why this is what they are using. Okay, meaning what is not there, okay, in the warehouse, those are the inventory that are sold, and what is left is their ending inventory. Okay, so this cost derivation also includes inventory that was already scrapped or declared obsolete and was removed from the stocks, okay, or even those inventory that were stolen, meaning ending inventory just pertains to what is left in the stock room. Okay, so thus the calculation tends to assign too many expenses, okay, for our goods that were sold and which were actually costs that relate more to the current period, because again, aside from those which are sold, probably they will account for those which were stolen and obsolete. Okay, so that's the reason why. For the entity using a perpetual inventory system, on the other hand, so in this type of inventory system, the entity will account for any increase or decrease in their inventory that affects or the transaction that affects to it, just like the sales and our purchases of the inventory. So meaning every time there is purchases, so they will debit purchase account, okay, and credit to any appropriate account like cash or accounts payable. And then if there is sales, aside from accounting for the sales transaction, they will also be reflecting the cost of goods sold, okay, related to the sold inventory. So they will have two sets of entry. So the first entry is for the sales transaction, which is debit to cash or accounts receivable, credit to sales, and then the second entry is to debit the cost of goods sold, credit to inventory. Okay, this is how it is done under the perpetual inventory system. Okay, so they continually compile okay, over time as goods are sold to customer or if there are purchases, okay, of the inventory. So this approach involves the recording of a large number of separate transactions. Okay, so they can even record for the sales, scrap, obsolescence, and so on to account, okay, how their inventory was taken, okay, from the warehouse. So if cycle accounting is used to maintain high levels of record accuracy, so this perpetual inventory system approach tends to yield a higher degree of accuracy because compared to the periodic system, here in perpetual inventory system, they always account, okay, whatever transactions relates to the inventory is. Unlike with the periodic inventory, they only wait for a certain period of time or the end of their accounting period to account for any inventory that is left in the warehouse, and whatever is not there, they assume that it was sold. Okay. So, to continue, basically we have here the different cost flow assumptions, okay, that is also used in computing or preparing our cost of goods sold statement. So here, the entity can use this cost flow assumption, but of course it will have later on an impact on their ending inventory, okay, as well as the income, okay, or the profit or loss. So we have here the two methods of inventory costing. Okay, so we have the FIFO and LIFO method. For the FIFO, this is first in, first out, meaning what was first purchased or produced, that should be the first inventory to be sold. Okay, that is first in, first out. So, in this type of costing method or inventory costing method, here the impact is in an inflationary environment where prices are increasing. This tends to result in lower cost, okay, being charged to the cost of goods sold because basically when the items was first produced, so the cost is low, okay, and then that the later inventory or the next inventory that will be produced will now cost more than the first one because we are in an increasing price trend. Okay, so basically those which were produced first will have a lower cost than those which were produced later. Okay, so that's why the result of this is lower cost of goods sold that will be charged to our cost of goods, or the cost, I mean. Okay, so because here those items which will be sold are those which were produced first, which has lower cost. So that's why cost of goods sold will also be lower. Okay. For the last in, first out method, so this is just the opposite of our FIFO method. In this case, this method is the entity will sell first those who those item or inventory which were produced last. Okay, so those last items or inventory that were produced, those are the inventory that should be sold first. Okay, so that's why in effect it will have an opposite effect, okay, compared to the first in, first out. In this case, in an inflationary environment and our prices are increasing, so the cost of goods sold would be higher because those items which were sold first were not, those inventory which were completed first were not yet sold. Okay, because the inventory that was uh, produced last. Okay, so those will be prioritized in selling first, which also has higher cost. That's why it will result into higher cost of goods sold. So if you would think of it, just analyze it as the opposite of our first in, first out. Okay, but in practice, in the industry, basically last in first out method was, I think, phased out, because the effect of LIFO method is those inventory that were finished, I mean, and were not yet sold, will tend to become obsolete, or it will be damaged. So that's why what is being used actually in the practice is the first in, first out. Those items which were finished or produced first, those will be sold first as well. Okay, to avoid obsolescence and damage and other loss related to the inventory. Okay, so these are the cost or the impact of cost flow assumptions in the preparation of our cost of goods sold. So here we have the formula and calculation for our cost of goods sold. For a merchandising firm, so this is what they usually follow. So beginning inventory plus purchases. Okay, again, the sum of this is what we call cost of, total cost of goods available for sale, or goods available for sale, I mean. Beginning inventory plus purchases is equal to available for sale. Okay, goods available for sale. And then we will deduct the ending inventory, meaning these are the inventory that was left in the stock room at the end of the accounting period. So therefore, what was the difference between the cost of goods available for sale and deducting the ending inventory is what the entity actually sold, and that is equivalent for our cost of goods sold. Okay, for a manufacturing firm, actually we have a much longer formula, because if you are a manufacturing type of business, you will have three types of inventory. So we have the raw materials, okay, plus we will add to it the manufacturing costs like your labor, direct labor, and factory overhead. And then after that, we will also include those inventory which were already started but not yet finished, and that is what we call in work in process inventory. Okay, and then the third inventory is the finished goods inventory. So that's why for a manufacturing firm, it's we will have a much longer formula, okay, in preparing and computing for our cost of goods sold. So in this illustration, this is just the shortcut, okay, of it. So for a manufacturing firm, our cost of goods sold is equal to cost of goods manufactured. So cost of goods manufactured, again, this is the sum of your direct labor, direct materials, and factory overhead. So aside from that, it also includes the items which were already started but not yet finished, our work in process inventory. This is your cost of goods manufactured. So from there, we will add the finished goods inventory beginning. Okay, and then when you add the cost of goods manufactured and the finished goods inventory beginning, their sum is what we call finished goods available for sale. Okay, and then we will deduct those finished goods inventory or ending inventory. So meaning their difference now between the finished goods available for sale and finished goods in inventory ending, this is your cost of goods sold. Okay, so or in other words, available for sale minus those for those inventory left in the stock room. So the difference is what you already sold. Okay, that pertains to our cost of goods sold. Okay. So inventory that is sold will appear in our income statement as mentioned earlier as part of our cost of goods sold account. So here, you all know that when we say beginning inventory, this is the ending inventory last year and was forwarded in the current year. So that is our merchandise that was not yet sold in the previous year. So that is what is left last year. It will be forwarded this year plus what we have produced. Those are the total available for sale item. Okay. So of course, in the balance sheet account, these transactions will have an effect, okay, in our balance sheet because we are talking about inventory, and your inventory is part of our current asset account. Okay, so we have here an example on how to calculate the cost of goods sold. Okay, for example, a company has 10,000 of inventory on hand at the beginning of the month, and then they spend 25,000 on various inventory items during the month and has 8,000 of inventory at the end of the month. So what was the cost of goods sold during the month? So using the data given and following our formula, so basically this is you can use the simple formula, okay, based on the given. So here, what we will do is we will add the beginning inventory with the purchases. This is, I think, a merchandising type of business, okay, because the formula says it so. Okay, so we have the purchases account. They do not produce their own inventory. They just purchase it from a supplier and resell it. So that's why we will use this formula. So again, a beginning inventory of 10,000 plus our purchases of 25,000. So the total of this is what we call goods available for sale, which is equal to 35,000. And then after that, we will deduct the ending inventory of 8,000. So what was not there, okay, in their hand was actually the item sold, and its cost is equal to 27,000. Okay, so that's how you solve using our cost of goods sold formula. But this one is for a merchandising type of business. Okay, so fraud and cost of goods sold. Okay, so actually, for purposes of personal interest of the management, in order for them to have or to reflect a higher profit amount in their income statement, so they can actually alter the amount of cost of goods sold, meaning they will tend to decrease the amount of the actual cost of goods sold to reflect it in the income statements, so that it will result into a greater profit. Okay, so this is fraudulently altering in order to change the reported profit levels. So here they can, or the management or the entity can alter the bill of materials, okay, or labor, so that it will be lessened. Or they can also incorrectly count the quantity of inventory. Okay, this, when we say fraud, this is intentional. Okay, but if that is unintentional, that is error. But in this case, it's intentional. Okay, so they incorrectly count the quantity of inventory on hand. And aside from that, performing an incorrect period end cutoff, meaning if cut-off means that only those transactions that pertains to this accounting period shall be recorded in this period, and those transactions which occurred in the next period will be reported in the next period. But for some personal reasons, probably, so they included or disregarded some of these transactions. Okay, those items were not properly accounted for in the proper accounting period. Okay, and of course, allocating more overhead than actually that exists to inventory. Okay, so again, this fraud in cost of goods sold may be done, okay, and was done actually or will be done by the entity for their personal interests. Okay, but again, this should be avoided because this is a violation of our GAAP, okay, and as well as the preparation of the financial statement. Okay, so we will proceed with what does the cost of goods sold tell us. Okay, so here, this is used actually as an important measure, okay, in our financial statement because this is an element that is being subtracted, okay, from the company's revenue to determine our gross profit. So basically, gross profit is a profitability measure also that is used to evaluate how efficient a company is managing their assets, okay, in producing the goods or services that they will sell. Okay, so that's how important cost of goods sold is. So because cost of goods sold is a cost of doing business, or this is simply the capital that was used, okay, by the entity. So this is recorded as a business expense in our income statement. So here, knowing the cost of goods sold will help the analysts, the investors, as well as the management to estimate the company's bottom line or profit or loss, net profit or net loss. Okay. If cost of goods sold increase, of course, the effect of that is your net income will decrease. While this movement is beneficial, of course, especially for tax purposes, because taxes are based on the net profit or income of the entity. So that's why cost of goods sold is also essential as well. Okay, so in order for the entity to pay for lower taxes, so they should maintain a lower cost of, sorry, if they will or if the management, I mean, would want to pay lower taxes, so they will tend to make their cost of goods sold higher to reflect their income to become lower, because the lower the income, the lower the taxes. But on the other hand, if the entity wants to increase their profit figure, so they have to keep their cost of goods sold as low as possible. So again, this depends on the result, the actual result, and not on the objective. But of course, if they have the objective, they should meet it as well. Okay, so cost of goods sold is the acquiring, I mean, of or manufacturing the products that a company sells during a period, or I mean, these are the costs which relates to the acquisition and manufacturing of the goods or rendering of the services. So of course, though only those which or only those costs which are directly related to the production, okay, will be included. That's why we emphasized here that it will include only direct materials, direct labor, and factory overhead. Okay. But other costs or indirect costs such as promotion and sales should not be included because they will have their own category as expense in our income statement. Okay, furthermore, costs incurred on the cars that were sold during the year will not be included, whether the costs are direct or indirect. In other words, cost of goods sold only includes the direct cost of producing goods or services. This is what we are mentioning earlier. Okay, so cost of goods sold again include only direct cost of production or producing of those goods or rendering of those services, okay, that were purchased by the customers during the year. Okay, so this is for our cost of goods sold. So accounting for methods and our cost of goods sold will be discussed in the next video lecture.